All right, let's just jump right into this explainer with a kind of uncomfortable question. You think you made money in the stock market because you're, exceptionally gifted, right? A once-in-a-century financial genius. Well, today we're going to find out if your stock market wins actually prove your brilliance, or if, in the eyes of Wall Street big shots, you're literally just a pig doing push-ups in a rising elevator.
To really grasp how the financial world measures success, we absolutely have to talk about two massive concepts, alpha and beta. And honestly, there is no better way to wrap your head around them than the pig and elevator theory. So, picture this. Imagine a pig inside an elevator. It's doing push-ups, sweating it out, working hard, while the elevator itself is just rocketing upwards. The doors open, the pig steps out, and thinks, wow, I made it to the 50th floor because my push-up game is just that strong, completely ignoring the fact that the elevator itself was traveling at top speed.
So let's compare these two totally different forces. That massive, unstoppable upward force of the elevator, that's what Wall Street calls beta. It's basically the dividends of the era, the overall rise of the broader market. But what about those few extra centimeters the pig actually gets off the floor while doing those push-ups? That tiny bit of extra height is alpha. That is true skill.
Let's break that down just a bit more. Beta is your systematic risk exposure. When the broader market is just booming, when that elevator is shooting straight up, beta means you're going to make money even if you're picking stocks with your eyes closed. Literally. If the market goes up 10%, your stock goes up 10%. That chunk of your money, it's basically a free gift from the market.
But then we have alpha, and this brilliantly illustrates what Wall Street actually cares about, hunting down that elusive alpha. Alpha is your abnormal return. It's the money you made through actual undeniable talent, purely from your stock-picking ability, after completely stripping away the market's free ride. It is that extra height genuinely created by your true skill.
Now, to actually find this alpha, finance pros rely on the absolute cornerstone of modern finance, the capital asset pricing model. We usually just call it CAPM. Think of CAPM as this foundational weapon that rigorously decomposes, or, breaks down where an investor's money actually came from. The CAPM formula breaks down an asset's excess return into three really simple buckets. First up, we've got beta. Like we said, that's the return brought by systematic risk, your market gifts. Second is alpha, which is your actual abnormal return. That's the true manager skill. And third, there's an error term, which is honestly just random luck or noise that the model simply cannot explain. Okay, so here is the crucial takeaway. If your alpha is greater than 0, huge congratulations, you have real skills and you're actually outperforming the market. If your alpha equals exactly 0, well, you have no extra skill. You're just capturing normal performance. But if your alpha drops below 0, yikes, you are actually underperforming and potentially destroying value, regardless of what your total bank balance might temporarily trick you into believing. We can actually understand this in seconds using something we all survived, a heavily curved final exam. Okay, let's say a university exam is brutally hard and the class average is sitting at an awful 50 points. The professor panics, right? So they universally add 20 points to everyone's score. That plus 20 points unconditionally handed out by the professor, that is your beta, the benefit of the overall average rising. Now let's say your final score is an 80. Well, 50 was the base, 20 was the beta, which means the 10 points you earned above the average from studying all night, that is your true alpha, your real scholarly strength.
But here is the trap. What if your final curved score on that test was a 65? You might look at that and think, hey, I passed. But wait. The professor gave everyone 20 free points, remember? That means your actual original score was just a 45. You scored below the class average. Translated to financial terms, your true scholar alpha is actually negative.
All right, before we apply all of this to the real world, we need to quickly lock in some essential vocabulary. Remember how all of these calculations are based on excess return? Well, excess return is simply the money you made minus the risk-free rate, which is the guaranteed interest you'd get from super safe government bonds. You always have to subtract that risk-free rate first to see what you actually earned for taking on real risk. Only then can you decompose the returns to separate your real skill from the market's natural movement.
Let's take this to the real world and see how it builds our ultimate weapon. In the finance industry, this very concept is used to expose the true colors of so-called star Wall Street fund managers. You see these managers bragging all over the place about massive 20% returns in a bull market, and they actually have the nerve to charge everyday people extremely high management fees for it.
But here's what's really interesting when you actually run the numbers. If you take those star managers and run a regression model using the CAPM, you'll often uncover a shocking reality. Their beta returns, meaning the market doing all the heavy lifting, might account for 25%. So since their total return was only 20%, that means their true alpha is actually negative 5% after fees. They didn't beat the market at all. They literally dragged it down. Understanding how to separate alpha and beta is your absolute shield against being scammed by Wall Street's false advertising. Whether you're analyzing data for a new job or just buying funds for your own portfolio, you absolutely need to know this. Never ever pay premium management fees for simple market momentum. You do not pay high fees for a free ride. It's just that simple. So as you continue your financial journey, I want to leave you with this thought. In the financial world, never mistake the dividends of the era for your own ability. Stripping away beta to find true alpha is a lifelong necessity. Ask yourself, are you actively building true alpha, or are you just paying someone else to ride the elevator? Thanks for joining me on this explainer, and I'll catch you next time.